Welcome to Nothing But Net Income, where valuations are the endgame. This is a brand new channel. If you do like this video, please actually like it. Comment with me. I love to hear your thoughts about new topics or new stocks, new valuations you want to see. Share this video with your friends. Be sure to subscribe. Let's talk about today the Honest Company. The ticker is HNST, and this is a company that's all about personal care products. So these are the things that you see around your house all the time. It's a very easy business model to understand. They sell diapers, they sell wipes, they sell skincare products, they sell cosmetics, and they sell even baby clothes, and they sell gifts for other people. So this is really a consumer company, and they're direct to consumer. That's that DTC you see there. They're really all about clean, sustainable products, and the founder is actually actress Jessica Alba. This stock came to the public markets just a few years back now, but it has really failed to gather any sort of actual investor base, and I'm going to tell you whether or not the valuations that we say today are worth it at all. So let's dive right in. So one thing you need to know about every stock is that you can pretty much Google the ticker and then investor relations, and you can find all of the quarterly reports, the annual reports, and then any official publications that the company puts out, that these are legally obligated to put out because they are a public company. And so I went right here to the Honest Investor Relations page, and I'm seeing the second quarter results. They came out yesterday. I'm recording this on the 9th of August, 2023. And so we've got some good news. That second quarter revenue was up 8% over 2022. They raised their full year revenue and adjusted earnings before interest, tax, depreciation, amortization outlook. So that's really the main meat and potatoes of the business, if you will. It takes out some of the extra things that weigh a business down, if you will, and there's some operating cash flow improvements here too. Those are the highlights, and so I do want to show you how the breakdown of the different segments. You got diapers and wipes make up $55 million of sales. For the quarter, you have skin and personal care making up $22 million, and household wellness. These are these other products. I think this also includes the clothing, if I'm not mistaken, for about $6 million, for a total quarterly revenue of $84.5 million. And this is up, like I said, 8% since this time last year. So let's just take this into consideration as we also view some of the other things that are very important when you're assessing a business. The current assets, you want to look at cash and cash equivalents. So the company currently has over $17 million of cash. And remember, these numbers are in thousands when you're looking at balance sheets, so they keep off the zeros just to keep it a little cleaner. And they've also got current liabilities down here. You need to look at how much current liabilities a company has. They have 41 million, of current liabilities, and that adds up to a total of 68 million in total liabilities here, which is far less than their total assets. And one thing I did notice that's really important is they've been bringing down their inventory quite a bit from 6 months ago. When you're looking at December 31st, 2022, they had 115 million of inventory, and they've brought that down quite a bit, over $20 million worth of inventory here in the first half of the year. And that was really, it's making them a more asset-light company, but also freeing up some extra breathing room, if you will. So these are important things to look at. Let's dive into the valuation now, but before that, we're actually going to get into the risks of this stock. So there are risks that you should look at when you're looking at any different investment. And the first thing I want to tell you right now, this is not yet a profitable company. They got a cash burn an estimate of about 9 to 12 months before they might need to acquire a little bit more cash to keep themselves afloat. They're probably not going to go bankrupt, but they might have to sell shares, which dilutes your existing shares as a shareholder, or they might have to acquire another debt deal, which we know in the high interest rate environments, debt deals are not always the thing you want to be doing if you can avoid it. So if they can turn a profit in that time frame, they might not have to do either of those things, but that is very unlikely given the current situation. So you probably will see a little bit more dilution or a little bit more risk with acquiring more debt in the near future. However, they do have also current assets of 144 million and current liabilities of 41 million. So that's not nothing. They do have some outstanding debt, and they can't pay it off with the cash that they have on hand. They have only 17 million in cash on hand. So like I said, it's not the most bulletproof company, if you will. And there's a risk with going into recession that people are buying down. They're not necessarily buying the most expensive brands or the top of the line products. People do always spend more on their babies and their kids, but there's increased revenues that are not you know necessarily driven here by a single consumer going out and buying just 6 boxes of Honest products. They're not. That's not what's making their revenue jump right now. I think the increase you're seeing in the 8% revenue is actually increased prices. You're looking at they raised their prices to mid to high single digits, so 7, 8, 9% in the past few months. And they expanded to more stores. Honest is now, they used to be in 43,000 locations. Now they're over 50,000 locations. So I think this has a lot more to do with the revenue growth than people actually buying more of their products, each individual consumer. And that's the kind of growth I want to see, and I'm hoping in the long term we'll see more of that. And now let's kind of try to get into that. How am I possibly slapping a 10x valuation on this stock then? Let's look at the last 4 months or the 4 quarters of revenues. The TTM, that stands for trailing 12 months. So quarter 3 last year, they had 84.5 million, and then the next quarter, 83.3 million. In the first quarter this year, 81.8 million, and now they're back up again. They're maybe reaccelerating a bit to 84.6 million again. So this is all averaging out to about $336.9 million for the last 12 months of revenues. And now this is a nice number. I see it's growing over the last few years that we've seen. And how do you really look at a company that's not profitable? You look at the price to sales ratio. So another company that you might know in the space is Kimberly-Clark. They sell the Huggies brand. They have a price to sales ratio. That's basically looking at the price of their stock divided by how many $1 million of revenue or billions of revenue they have. So you're looking at the market cap divided by that, and you get a price to sales of about 2.12 for that company. Another company you might know, Procter and Gamble, they have the Pampers and the Loves brands, and their price to sales is a little higher because they have like 2 name brands, and they're one of those companies that's considered a blue chip stock. They're really bulletproof. They got a great balance sheet. They got great leadership and proven track record over lots of years. So they get a little bit of a premium, if you could say that. But again, this is just the diaper segment. That's not even all that. That's not even all that the Honest company's trying to do. They're also trying to do makeup and personal care. So I took some companies like Elf Beauty. They've got a really high price to sales ratio because their management team has just knocked it out of the park in the past few years. They got a price to sales of 10.99. So that's on the higher end. And then Ulta Beauty, they're a makeup retailer, and I do want to be a little bit more honest with this valuation. So let's look at the valuation being a little bit of an average between all of these. So you got some low end, you got some high end. I do want to be conservative, and it was a little bit over 5 when you average these out. So I'm gonna just we're gonna keep it at a price to sales of 5, and this is a lot. For a company that's maybe not profitable, and they have a long way to go. So I'm not saying that this is going to be like next year's valuation. It might be 2-3 years out. It's definitely not tomorrow's valuation, but I think that they can get there, especially if they keep their business afloat. They shore up a little bit more cash, and you could definitely see this company trading at a price to sales of 5 in the future because they're going to have these higher end margin products like these skincare products and makeup and things. So if we look at a company, the company today when the market opened, like again, I said this is on the 9th of August, 2023 here, and they had a market cap of $142.8 million. And now you take a 5 price to sales on a $336.9 million revenue company, and that gives you a $1.684 billion valuation. Now, if you want to know how you do that, that's literally just you just multiply those two numbers together to get $1.684 billion. And like I said, the current market cap being only 142 million, if you multiply that by 10, you're looking at a valuation of only $1.42 billion. So again, this is a little on the conservative side. I don't want to be just saying swing for the fences here. They're gonna kill it and they're always gonna hit their numbers. But again, I took a more conservative price to sales. I took a more a 200 you got a $200 million cushion between where it could be if there's a 5 price to sales, and then you know where it is currently if you go 10x from today's market cap. It's not too late to buy this stock if you really want to hop in, and I would say it's definitely something that you want to consider if you're looking for a higher risk, higher reward play that could eventually, in the consumer staples place, be a household name and could maybe one day throw off a dividend. And a lot of these companies like to do stuff like that to return that value to shareholders. Thank you guys so much for tuning in. I am Adam with Nothing But Net Income, where valuations are the end game. And if you like these videos, be sure to check back for more. Comment down below what types of tickers you want me to do next. So thanks and take care. Have a good one.